All right, so let's talk a little bit first about this big deal. It's only about a week rather, since it's been announced, but it's been possibly years in the making given some of the trends that we've seen in the actively managed ETF market, Bryon. So why Goldman Sachs Asset Management and why Innovator Capital Management, and why is it a good tie-up?
Yeah, well, you talked about it. Goldman Sachs is really committed to our asset and wealth management business. Our asset management business in particular, $3.5 trillion asset manager. We're the 8th largest asset manager in the world. We're top 5 public active. We're top 6 in private alternatives. But as we think about the major trends that our clients are talking to us about, it's in the active ETF space. And so we have this leadership position in public active, but we know we need to deliver more to them in that way. And so we've got our active ETF business that we've been building for years now. We're really proud of that business. We're going to continue to invest in that. But to accelerate us down that path, we did this deal with Innovator. We've loved that business for years. We've known the founders. We've known the team. We're really excited about this space that they've invented, the defined outcome space. And so when you brought all those pieces together, it really just made a ton of sense.
How much of this story for Goldman Sachs GSAM, Goldman Sachs Asset Management, going after Innovator, is driven straight up by the demand for these types of products? We've been talking about buffer ETFs, defined outcome ETFs for some time, but this seems to me like a very big bet on the future of these types of instruments. So what exactly is the maybe main driver, if you will, for what happens?
So if you think of the identity of Goldman Sachs Asset Management, we focus on the really kind of sophisticated area of the markets and solving those problems for investors. So whether that's direct indexing, whether that's evergreen alternatives, or whether that's active ETFs, that all kind of lives in the same neighborhood for us. And so we think the entire active ETF space is interesting, but defined outcome in particular is a very fast and attractive space to us. It's solving particular problems for investors. They're looking for income, they're looking for downside protection, they're looking for further growth, and it's kind of on this critical path of innovation that's happening in the marketplace right now, where more and more investors are using defined outcome ETFs in their portfolios. And so it was incredibly complementary to our identity as an asset manager, and it was also at this really exciting point of the growth curve of defined outcome ETFs, which we think could 4 to 5x over the next 5 years.
This is a big deal for sure. From an independent, investment advisor's perspective, Nick, when you take a look at some of the products that are out there from ETFs and how they've evolved, these defined outcomes are basically something that maybe more advisors are starting to look more closely at right now. Are you one of those types of advisors? And just how much do your clients on the high net worth or ultra high net worth side of things want to use these types of products as opposed to other wealth management strategies that have been in place for decades at this point?
Yeah, for instance, these have, as you mentioned, existed for quite some time, whether it be in the structured product arena, whether it be in option overlays within investment portfolios. We think there's both a client demand for these. We also see a role for them in portfolios. The way we kind of categorize many of these, and for us, it's really coming at the angle from equity exposure with downside protection built in is oftentimes how we're thinking about this. And we fit these more in what we call a risk-aware growth bucket, where it's enabling our clients to have access to public equity markets, but with some measure of systematic downside protection built in.
How much, Nick, from your perspective, do you think about using these types of products in the ETF wrapper? Cookie cutter is not the right way to look at it, but it becomes packaged, right? You have a product that you can buy right off the shelf, and it does the things that you want to do, as opposed to having a separately managed account for a client that then you actively put options overlays or hedging type strategies in place to enhance or try to get the same kind of outcome. Which is the more desirable outcome for you?
It'll depend client by client, situation by situation, as do many things in investment and portfolio management. We look at the cost side as a consideration, and there's the operational ease. Obviously, the ETF vehicle, the operational ease side is infinite there in terms of being able to have same holding, same portfolio construction across a multitude of clients and manage that scalably. On the cost side, right, as competition is intensified in this space, right, the costs are very much reasonable, and oftentimes what we see is in line with what you're looking at within the SMA space. And so, generally speaking, we have plenty of clients where we do option overlays on top of separately managed accounts. We also have model portfolios constructed of ETFs, leveraging many of these types of defined outcome strategies, as well as other risk-managed equity strategies.
The interesting part about this, Bryon, because we brought up the fee idea here, it's not that these things just happen willy-nilly. There is a cost to transaction-wise or anything else to putting these kinds of structures together. I think about the type of buffer or defined outcome product that we have today. And it was very much an ETF product today, but that was a structured or some kind of a nuanced product for high net worth or accredited investors just 10, 15, 20 years ago, aka hedge fund-like strategies. Right. So if you look at the costs for a hedge fund type product 20 years ago versus what the ETF cost for a similar type of outcome is today, how exactly do they compare?
Well, there's a big difference, and by the way, you're just thinking about cost as like an expense ratio, but what about convenience, like Nick talked about? What about the intraday liquidity that the ETF wrapper brings? What about the comfort of mind of knowing exactly what you own because of the transparency that's provided? And so when we're talking to investors right now, they're thinking about all of these things holistically, and so of course they're making sure that they're paying a fair price for the vehicle that they're getting exposure to, but they're actually taking in a number of different things in the account. How they're serviced from the asset manager, the performance, the totality of the product offering, the website. All of these different things play into that equation. And what you're seeing, and you're making this point, Dom, is that when you take all those into account, put this into the ETF wrapper, the benefits to investors are immense.
From an RIA's perspective, if you take a look at the way that these products are being used, are you seeing a ramp up on your side of things, not just from your shop in particular, but maybe across the industry from independent RIA's perspective? Are they starting to kind of dabble more, traffic more in these actively managed ETFs that target outcomes?
It's definitely seemed that way, absolutely. You know, on our end, where I can speak obviously most intelligently about, where we've used it a lot is for clients where we're looking for public equity exposure, but there's this desire, whether it come from the client end or from our perspective of saying, we want public equity exposure on the upside, but we want to have some systematic approach to protecting on the downside. And so we look at these defined outcome buffer products sitting right alongside perhaps equities with cover calls or trend following equities where there's a systematic rules-based approach to get you out of the market during those sell-offs. For us, ultimately, we know that over the long haul, one of the biggest determinants of investment success or failure is going to be how an investor behaves. Right? Equities go up and they go down over the long haul. They tend to work their way upwards to the right. But we know as through years of experience, right, the ride is anything but smooth. And so if we're able to build portfolios that our clients can feel comfortable in, have conviction in, and ultimately have that discipline to ride out the market's inevitable downside, all the better. And so for us, this category of these risk-managed equity solutions we think plays a role in a portfolio. And that's where our adoption has really been driven by.